Banking Drive Committee presents you yet another video on the functions of Security Exchange Board of India, popularly known as SEBI. So the first function today which we'll be explaining is prohibition of insider trading. So in a key policy move, the Securities and Exchange Board of India has decided to hold company promoters irrespective of their shareholding status responsible for violation of insider trading norms if they possess unpublished price sensitive information or UPSI regarding the company without any legitimate purpose. During the year 2002-2003, 13 cases of alleged insider trading were taken up for investigation. A total of 14 cases of insider trading were completed during the financial year. SEBI has specified that the term legitimate purpose will include sharing of the UPSI in the ordinary course of business by an insider with the partners, collaborators, lenders, customers, suppliers, merchant bankers, legal advisors, auditors, insolvency professionals, or other advisors or consultants, providing that such sharing has not been carried out to evade or circumvent the prohibitions of these regulations. So the next point which we'll be completing is substantial acquisition of shares and takeovers. So before starting that, we need to understand what a substantial acquisition of shares and takeovers is. So when a company acquires 5% or more than 5% of another listed company or the target company, then it has to make a disclosure of all its holdings within 2 days of acquisition of the shares. In other words, when a company acquires 5% or more of percent of the shares of the target company, then it is called as a substantial acquisition of the shares. SEBI on 16 June 2020 amended a portion of the Regulation 3 and 6 of the Securities and Exchange Board of India, Substantial Acquisition of Shares and Takeovers Regulations 2011, also referred to as the Takeover Code, to enhance creeping acquisition limits, providing options of fundraising, along with possible consolidation of shareholding as a defense mechanism. During the 2002-2003, 83 cases were referred for adjunction under the Section 15 of SEBI Act 1992 for alleged violation on the provision of SEBI, the Substantial Acquisition of Shares and Takeovers Regulations 1997, and a total of rupees 73 lakh 95,000 crore were received towards monetary penalties. The third point which we'll be explaining today is inspection and inquiries. The Section 11(2) of Securities and Exchange Board of India Act 1992 provides that the SEBI would register and regulate the working of stockbrokers and subbrokers. In fulfillment of the above, the SEBI carries out inspections of the books and record of stockbrokers to verify whether books of accounts, records, and other documents are being maintained in the manner specified by the Securities Contracts Rules 1957 and SEBI Stockbrokers and Subbrokers Regulations 1992. The provisions of the SEBI Act, the Securities Contracts Act, and the provisions made by the there under are being compiled by the broker. Adequate steps for redressal of grievances of the investors are being taken, and the conditions of the registration as a stockbroker are compiled with. So the common irregularities noticed during inspection were non-maintenance of proper books of accounts, non-issuance of contract notes in proper format, and non-fixing of broker's note stamp on contract notes, non-reporting of off-the-floor transactions to the exchange, misuse of the exchange settlement mechanism to secure certain loan transactions which do not have any relationship to security business, dealing with unregistered subbrokers, and non-segregation of clients and proprietary funds. So during the 1997-98, 157 brokers from the 22 exchanges across the country were inspected by the SEBI. For inspection of brokers of BSE and NSEIL of services of chartered accountants were availed of, whilst inspection of brokers of other stock exchanges were undertaken by the officers of the SEBI. During the course of inspection, following features were noticed. Brokers of regional stock exchanges had witnessed a slump in their business. Many of them were either inactive or working from the brokers of bigger stock exchanges. Clientele business in general had come down from across the entire country. Brokers were reluctant to execute orders which may result into the delivery because of impending fear of deliveries turning out to be bad. A large number of brokers were given indirect inducement to their clients to close their position at the end of the settlement by charging much lower brokerage for squaring up business compared to delivery business. The rate of brokerage had come down drastically over last few years. The bylaws of the stock exchanges provide for brokerage up to 2.5% of value of the contract. In reality, the brokerage ranged between 0.05% to 0.5%. So that is all for today. I hope you all liked the session. Please stay tuned and subscribe for more content. Thank you.